Hey guys, thank you so much for tuning into this week's episode of the podcast. If you haven't yet, please subscribe to our YouTube channel. We're trying to grow our channel, and as we continue on with the podcast, we want to start new forms of content. We want to start posting our work here on YouTube. So if you want to see some of that and continue supporting the podcast, please subscribe. Enjoy the episode. All right, hello everybody. Welcome to another episode of the Exordia Creative Podcast. If you've been living under a rock and you haven't bought GameStop, what are you doing? What's up, everybody? Hope you're having a good start to your week. And we're back. Another busy weekend. Good times.
This is officially the last podcast we're going to be filming at this location.
You know what? Actually, before you got here, I was thinking about putting some labor in and carrying this thing over there and doing one in that.
Mm-hmm.
And I was like, we'll just do it next week. Because I remember we had to take the door off to get this table in.
Yeah, we got a big table, yeah.
Yeah. So anyway, yeah, next week, new location. And stay tuned for that. Very excited. And bada boom, bada bing, on to another room.
Yeah, we're going to switch up the backdrop a bit, so looking forward to getting another chance to kind of redesign our space, not just the podcast, but our desk setup, the room layout.
Yep.
Not there's much difference in the new room we're moving into, but
no,
it's always fun to kind of refresh the space.
Yeah.
Bring some new energy into it.
Yeah. Bring the plants with us. A lot of our plants are dying, but we move on. We continue.
Yeah. Let's hope this shock doesn't freak him out too much.
Yeah. Anyway.
Yeah, we got a big move on Wednesday. It's really not a big move. You had another move over the weekend.
Moved over the weekend. Got everything done. Slept there. Fun. Great. Love the new space. Excited to call it home. Furniture doesn't come until March.
You have some stuff from your old place.
We have our stuff from our old house. But anyway, nonetheless, it's all good in the hood.
That's sweet. I know you've been looking forward to it for quite a while.
Yeah. Podcast news. We have some people that are asking to come on to the podcast. We've had a couple guests ask. And as soon as this COVID lockdown situation kind of subsides and we can open up a little more, we're more than happy to have guests on. That is the plan.
100%.
Is to have guests. So thank you to everybody that's expressed interest in coming on and people that have been nominating people to come on. We appreciate that. And we'll get to guests soon.
Yeah, we want to too. Don't get us wrong. We've got a third microphone ready to go.
Yeah.
We've got the extra camera if need be.
Yeah.
So if there's anybody who hasn't reached out to us who wants to come on, feel free to hit us up. Mm-hmm. Or if you have a suggestion for who you think we should talk to, maybe we can reach out to them.
Yeah.
Let us know. We'd be happy to do that. It doesn't just have to be a business owner. You know, anybody with a cool story, anybody who you think you'd find interest in us talking to, just let us know, because we're still figuring out what direction we want to take this in.
Yep.
Doesn't necessarily have to be somebody involved in some kind of business in Chatham.
We're only 40 episodes in, so we're still finding our stride.
Still young, for sure.
Takes a while to figure out this kind of stuff in life. I'm sure you guys know that. I'm getting a little sentimental, but yeah.
It's part of the journey.
Yeah.
Part of the process.
Jared, this whole episode, we got to talk about GameStop. We got to talk about what's going on in GME. We got to talk about what's going on in FTI. We got to talk about what's going on with all these crazy stocks, all this stuff. Everybody's getting into the market. Man. People are looking at it. They're like, what's Reddit? They're like, holy crap, Reddit's the new hedge fund. Oh my gosh, hedge fund this. Reddit's bigger than a hedge fund. What's going on,
You know
man?
what? We were going to talk about this last week, but I'm really glad we didn't, because 7 days later, this has got like complete mainstream media coverage.
Yeah.
It's everywhere. People I know who have never invested in their lives are now interested. They want to get in on this. They're hearing about all these stocks. GameStop is the main one. But like you said, there's also a few other businesses in the mix. Like,
I made up FTI, by the way.
Right. So there's like BlackBerry, which I actually talked about last week on the podcast.
Yeah, you did.
But that's getting involved. There's AMC, which is a arguably dying like movie retail chain, and there's a few. So everybody's talking about it. The memes are crazy. It's super viral. It seems to be Wall Street bets Reddit versus the real Wall Street, the corporate elite. So let's break it down. When did you start hearing about this? I know I asked you about it on a week ago. You hadn't heard about it yet. I found out about it like the week before, late the week before.
It was a couple days after the podcast that I started to hear about it.
Right.
So
I remember I talked to a few friends over the course of last week. They were just starting to get involved, starting to hear about it. But anyway, let's break this down. What's happening? So basically, there's this forum on Reddit. It's a subreddit called Wall Street Bets. It's been around for, I think, like 7, 8, 9 years. So it's nothing new. And they had a consistent following of maybe a couple 100,000 members. You check now, they're over 7 million members. So their growth absolutely exploded in the last week.
Last I checked, I thought it was 1.5.
They're over 7 million now.
Wow.
Right. So this is a subreddit on the website where people go to share investing news, advice, make risky plays, do a little bit of gambling, play with options, whatever. It's a
Wall Street Bets.
It's a mixed bag of people.
Yeah.
Anywhere from like very practical, fundamentally oriented, serious due diligence investors to people who are just YOLOing, like you only live once, doing crazy calls and buying options and whatnot. Anyway, now thanks to mainstream media and the virality of the situation, all the coverage, the forum's absolutely blown up. So let's talk about GameStop and where this came from. So first you have to understand the two sides of the party. So I've just explained the one side, which is the Wall Street Bets people, who are anywhere from like amateur young investors to pretty like seasoned investors. Anyhow, the other side is hedge funds. So what is a hedge fund? A little background for people who don't know. Basically, the term hedge means to hedge your bet or to offset some of the risk of your investment through diversification. So, for example, let's say you think the investments that you make have a 90% likelihood of happening. So maybe you invest 90% of your money into something that has a 90% likelihood of happening. But in order to hedge your bet or in order to minimize your risk, you might take the other 10% of your capital and invest into the inverse of the situation that you think is likely to happen. So it's kind of like a contrarian play where if you're 90% tanks, then that other 10% can be your saving grace. So essentially what hedge funds do is they make contrarian bets for rich people. So if you have a lot of money in like a market index like the S&P 500, that's all fine and good because you're quite sure that the S&P 500 is going to give you a decent investment return. But maybe for that other 5% or other 10% of your capital, which in the case of the people who tend to employ hedge funds is billions of dollars, you want to make a contrarian investment that benefits in the event that things don't go the way that you expect them to go. So oftentimes this ends up being like short selling investments or using options or counterplays or things that allow the investors to benefit in a negative situation. So, maybe the 10% of your investment allows you to make money in the case that things don't go the way you want. So that's essentially what hedge funds do. For example, I know on the podcast before we talked about Bill Ackman, who's a prominent short seller who owns a hedge fund, and he was able to make a play where he shorted the stock market prior to the March 2020 pandemic dip, and he was able to profit off of the loss that the stock market took. So it's a little bit of a way to hedge your bet. That's where the term hedge fund comes from. So these are typically like highly capitalized, really corporate people who don't have the best public perception because of some of the practices that they use in their investing, because of the connotations with greed and with exploitation and stuff like that. And also more recently because of what happened in the 2008-2009 financial recession and how a lot of these hedge funds and money managers were bailed out and everyday people were left holding the bag. So there's definitely a lot of animosity towards hedge funds from like kind of the Main Street everyday person crowd. So that helps you understand a little bit of the dynamic between the hedge fund side versus the Wall Street bet side. So with that background, one other thing you should probably understand is what short selling is. So when you're investing, you can kind of think of two plays as either going long or going short. If you believe in a stock and you invest in it and you anticipate it going up, you're going long. For example, you might be long Apple stock, or you might be long electronic vehicles, or you might be long a certain industry. And basically, when you invest long, you buy a company. Let's say you buy one share of Apple for $150. You anticipate it'll be worth more in the future. Maybe you buy one share for 150, you sell it in the future for 170. That's going long a stock. You anticipate it's going to go well. However, maybe you want to go short something. Maybe there's an industry that you don't believe in, like maybe it's fossil fuels, or maybe it's the airline industry, or maybe it's dying brick and mortar retailers like GameStop. If you anticipate that the stock is going to go down, by taking a short position, you can actually make money in the event that the stock ends up doing worse. So basically how short selling works is, instead of buying a stock, I borrow a stock from a brokerage. So let's use the GameStop example. Let's bring the GameStop example in. The case being made against GameStop is they're a dying retail brick and mortar brand. Everybody's going direct to consumer. Everybody's buying online. A lot of games are being sold digitally now, so there's less discs being traded. GameStop was always a joke for giving customers bad return value on their games. GameStop will actually buy back your used consoles, your used video games and stuff, and they would give notoriously low quotes. Like they'd give you $2 for a $90 game and stuff like that. That's their business model, whatever. So from a fundamental perspective, I can see the case against GameStop. I can understand how you could argue that that stock is probably going to be worth less in the future in the wake of our transformation toward e-commerce, and in the fact that they're losing equity and brand recognition. So prior to this, GameStop was losing price over the past several years now, was losing the value of their stock. But I think before things really took off, it was about $20. So let's say I'm a hedge fund and I want to help my clients make money off of the loss of GameStop. So let's say GameStop is trading at $20 and I expect it to go down to $2. I think the stock is basically worthless. I expect it to tank. So I want to make profit off of that move from $20 a share to $2 a share. What I do, contrary to going long a stock where I actually buy the shares and invest, I borrow them from a brokerage. So let's say I were to borrow one share. I borrow it from the brokerage and I sell it at its market value immediately for $20. I've now gained $20, but I'm still in debt one share to the brokerage. I now have to buy the share back in order to settle my debt with the brokerage. So in an ideal situation, as a short seller, I would borrow one share at $20. I would sell it immediately to a third party on the market. I would wait for the stock to go down to $2. I would buy that stock back. I would be profiting $18. I'd give the share back to the brokerage and settle my debt. So I can make money off of the difference. So now that you have an understanding of what short selling is and the case for maybe why GameStop should be worth less than it is now, you could see where these hedge funds were coming from. Now, they've been doing this for almost a year now. Shorting, taking profit, shorting again, and whatnot.
And it's happened in the past too, like with Toys R Us. That was a big one, I remember.
Yeah, this has happened all the time. On the Bill Ackman example, there was a really viral case maybe about 10 some years ago with a multi-level marketing company, Herbalife, between Bill Ackman and Carl Icahn. So that's another story that you could look into. Also, shortly after the 2008 financial recession, this happened with Volkswagen. There was a short squeeze, and we'll get into what a short squeeze is. But when you understand that the hedge funds were banking on this stock going to under $20, you can imagine why they're probably so alarmed now. Mm-hmm. Now, the difference between going short and going long is that with going long, you have limited liability, whereas with going short, you have seemingly unlimited liability. That's why options like short selling are typically reserved for savvy investors and people who know what they're doing, because you can really get burned if you don't. For example, if I invest $20 long in GameStop or $2 million long in GameStop, the most I could ever possibly lose is the amount that I put up. So if I invest 10 grand and the stock goes to zero, that really sucks. I lose 10 grand, but at the same time, I've limited my loss strictly to the amount that I put in. I can't lose more because I'm not leveraged. Whereas if you short sell, there's really unlimited potential downside to the trade. For example, if I borrow one share at $20 and I want it to go to $2, but then it goes to $25, I've now got to buy back at a $5 loss. Now you could imagine if instead of borrowing one share, I'm a hedge fund who borrows millions of shares to the tune of billions of dollars, And instead of the stock going from $20 to $2, it goes from $20 to $30 to $50 to $100 to $350. So you can imagine how indebted these positions are now, you know, for a gamble of probably a few dozen million, which is a lot of money. These hedge funds are now in debt several $billion. Now, what a short squeeze is where this really gets interesting. And this is where Wall Street Bets gets involved. And this is where they came to realize that there was a play to be made here. So because this has been going on for a while, like I said, about 6 to 12 months now, the hedge funds have been shorting this stock. And they've been doing it successfully. The price has been going down. They've been making money off of the difference. They've been profiting there. Now, due to what I understand as excessive greed, there could be more to it. They've now shorted the stock so much that they've shorted more shares than there are available in the float of the stock. And I know that's a little complicated, but what it means is they've shorted over 100% of the available shares on the market. They've shorted about 120 to 140% of the shares, depending on who you ask, which means they're now required to buy all of the shares in the float or all of the shares in the market. Wall Street Bets has realized this, and they're now essentially trying to play keep away from the hedge funds with the shares. All of these hedge funds, they didn't choose to invest long. They've taken on debt by a third-party brokerage and borrowed shares, which means they're legally and financially obligated to pay back those debts in the form of shares. Whether the price is $20 or $200, they're obligated to buy back billions of dollars worth of shares. So Wall Street Bets caught on to this. There was one user who made a fundamental analysis post way back in like 2019, over a year and a half ago. And he basically saw this as an opportunity because GameStop had recently got a new person involved on the board of directors, a guy named Ryan Cohen, who founded Chewy, which is a super successful pet supplies e-commerce company, which has since been acquired by PetSmart. But anyway, a very savvy e-commerce guy coming to GameStop. And if there's any chance of a dying brick and mortar brand making a successful transition to e-commerce, you're going to need some serious players like that. So that was good news for the stock. But in spite of Ryan Cohen joining the board, there were a lot of hedge funds looking to short it. However, fast forward over the past 18 months, this guy initially lost some money, but he kept holding strong. He kept adding to his position. He kept investing. He started to gain some attention on the board, Wall Street Bets, because he was posting his progress updates and he was posting some due diligence. More people get involved, and then somebody points out that the short volume is over 100% of the float, meaning that these hedge funds are so hell-bent on having the price go down that they've basically bet on more than there are circulating shares in the company, which you could argue is at best immoral and at worst illegal. But the point is that's the predicament that these hedge funds are in now. Wall Street Bets wised up to this, realized that at any price these shares have to be bought back. So now they're going to have their fun and drive up the price. And, you know, there's also a lot of sentiment of like anti-corporate greed, anti-Wall Street greed, because these people see this as their opportunity to take back what's theirs. All these people who may have been hurt by the 2008 financial crisis, by these big market makers and by these hedge funds, they see this as their chance to hit the big guy, like a David versus Goliath situation. Mm-hmm. So there's a lot of sentiment fueling that. And as I said, the board absolutely skyrocketed to like 7 million members. So now there's a lot of people. And these are average amateur investors. They're pretty undercapitalized. Yeah. But when you multiply their bankroll by 7 million.
Exactly. Like a lot of them maybe are putting $200 in here, like whatever. But then there's also the people in there that are putting in hundreds of thousands. So yeah, when you multiply all that, that's more than the hedge funds in some cases.
Yeah, exactly.
So basically Reddit is the new hedge fund. Wall Street Bets is a hedge fund.
Right. It's like a decentralized hedge fund.
Yeah.
Right. So there are a lot of arguments going around on both sides. Like, is what Reddit's doing market manipulation? I would argue no, because they're simply using publicly available information. Like, for example, anybody can go and find out that over 100% of the float is shorted. That's publicly available information.
So, like, what do you think of all this? Like, what do you think of this? Like, from your opinion?
I mean, I think it was only a matter of time before people started organizing themselves in a way to do this.
It's insane that it took this long.
Yeah, I think that this is just like a natural symptom of where technology is heading.
Yep.
I think, you have to understand that some of the Wall Street firms that are that you're seeing in the news now, like Melvin Capital, who's a prominent hedge fund, who are probably on the verge of bankruptcy now, Citron Research, a popular online short seller, who've made a couple correct calls, like Nikola Motors, the fraudulent hydrogen autonomous vehicle company. They called out their short position. Anyway, that's kind of where this stems from. But what's really interesting to me is some of the response from some of the brokerages and some of the hedge funds. So I don't know if you heard, but Robinhood was under a lot of scrutiny for stopping their users from buying.
Yeah.
Right. And it's a complicated situation. It goes pretty deep, but basically all of last week, the stock was really taking off. It went from $50 to $200 to $300 to nearly $400 at one point. And basically what Robinhood did, which is a direct-to-consumer brokerage for people in the U.S., so in Canada our equivalent would be like a Wealth Simple. Yeah. It's a brokerage where they allow traders to buy fractional shares and invest using options and leverage, which is ethically ambiguous, but that's another story. Anyway, when this stock started taking off, they banned users from buying the shares. As well, another handful of shares like BlackBerry, Nokia, AMC Theaters, they restricted users from buying. And where this gets tricky is, first of all, that's intervening with the public market, and that's intervening with regular supply and demand curves. Yeah. Right. But what's really interesting is they chose to allow users to sell, but they didn't allow them to buy. So that's very obviously biased in one direction. And what happens when users can't buy, but they're allowed to sell? Well, it decreases demand and it lowers the price. Yep. So why would a brokerage like Robinhood be incentivized to do something like that to lower the price? Well, here's where it gets interesting. Robinhood doesn't actually fulfill these purchases and exchanges of shares themselves. They simply intermediate them.
I've been told that they're more of an interface.
Right, exactly.
Robinhood is like an interface.
Exactly. Yeah. They simply intermediate these companies. And Robinhood isn't necessarily capitalized enough to pay the collateral to other third parties, aka clearinghouses, aka massive frickin' banks that actually fund these transactions. So in the case of Robinhood, they work with a firm called Citadel.
That's what it was. I wasn't sure if it was Citron or Citadel.
Right. So Citron is just a small short selling fund. Okay. They're not very big at all. Citadel is a massive, massive investment bank. So they're kind of on par with like a JP Morgan Chase or a Goldman Sachs. And essentially what they do is they're the ones who are really processing the transactions for Robinhood. As I understand, they're what's called the clearinghouse. Now, Melvin Capital, which is a hedge fund, which took part in short selling the stock. By the way, this hedge fund is probably worth several billion, but that's not even a drop in the bucket compared to a major bank like Citadel. Anyhow, over the course of last week, Melvin Capital, the short seller, took an enormous loss as the GameStop shares started rising, and they had to be bailed out by their parent company, Citadel, to the tune of like $2 to $3 billion. Anyway, you can see how Citadel, as the sponsor of Melvin Capital, the short seller, is being hurt by the price increasing. Yeah. Now, you also have to understand that Robinhood, the brokerage that everyday Joes go on to buy GameStop, is in part being capitalized by Citadel. Yeah. So typically what happens is Robinhood, when they're processing transactions and sending them through to Citadel, they have to put up a certain percent of collateral. Usually it's around 9 or 10%. meaning that for all the volume of money exchanged, they have to provide to their clearinghouse about 10% of collateral. Now, Citadel, from a risk management perspective, they see the volatility in GameStop and they say, hey, this is getting crazy. We can't afford to do this. We need to raise collateral requirements to 100%. Now, all of a sudden, Robinhood is being asked to front way more money to Citadel. They can't afford it. They're essentially forced, so to speak, to pump the brakes. And that's why they stopped allowing users to buy GameStop, not only that, but BlackBerry, Nokia, etc. So what's interesting is their strategic decision to stop buying and not selling, which is going to incentivize downward momentum in the stock price. Because if there are a lot of sellers but zero buyers on one of the biggest brokerage platforms in the United States, you're going to see the price take a hit. And you did, if you just take demand to zero instantly. Now, what's interesting is the firms like Citadel have something to gain from the price going down because they're supporting the funds that are betting against the price. So the water gets muddy really quickly when you start to see how these parties are interconnected and how both Robinhood and Melvin Capital are both sort of in cahoots with Citadel, and how Citadel has a financial incentive to keep the price down. That's where things really get interesting.
Yeah.
So for a lot of people, this has really blown the lid off of some of the layers of the financial system and how it works and how arguably deeply corrupted it really is.
And this has been going on for so long.
Right. And of course, the example that everybody is using as like personal motivation to screw over these hedge funds is what happened in 2008.
Yeah.
Where essentially a lot of these, not only hedge funds, but major banks. Yeah. And by the way, there are levels to this. Like you might think a $50 billion hedge fund is enormous, and it is. But when you look at some of these big investment banks, $50 billion is nothing to them. So when these major institutions get federal bailouts after the entire financial system essentially collapses due to like faulty mortgages and whatnot, that ends up hurting a lot of people. And you know, that sparked the Occupy Wall Street protest and whatnot. And it was a really brutal time in America. And I'm sure some of the people even watching felt some of the repercussions of the 2008 financial crisis. But for people like that to see these like overpaid financial executives walk off scot-free and still get to keep their massive bonuses and not be penalized in any way for, you know, doing something so damaging to the economy, it's really insulting to the average person who works on Main Street.
Yeah, and this in comparison is nothing,
right?
As far as like the financial catastrophe of 2008, like this is like you said, like a drop in the bucket.
However, I do seriously believe this has real potential to get bigger.
Yeah. Well, now the lid's blown off it, and everybody's getting in on it, and there's 7 million people now in this Reddit thing. Like this is Web 4.0.
Yeah, 7 million people is no joke. So anyway, people are using that kind of pent up aggression toward these like billionaire Wall Street types to fuel their motivation to keep buying the stock, because they know that as these firms have short positions, they're obligated financially and legally to buy back at any price.
Yeah.
So if they can keep away with the shares, keep the prices up, the firms are forced to buy them back. So as if that's not interesting enough, here's where I think things could get deeper. Because
let's go deep.
These hedge funds, being short GameStop is not their only position. They've got lots of massive positions, and this one isn't the biggest. Now, where this gets interesting is if they keep getting bled and their debt keeps getting higher and higher, eventually their options are going to come to terms, and they're going to have to pay those debts. And in the case where they need to raise billions of dollars to do so, they're going to have to sell off other positions. Right? Meaning, you know, if these hedge funds and these banks need to come up with 50 billion or whatever it ends up being, you know, it could end up being conceivably a lot more than that. They're going to need to sell off some of their other investments, some of their long investments, meaning, you know, your typical market indicators like your Dow Jones and your S&P 500. You could actually probably see a reflection in those prices. And you could see that last week. Asian markets were down. Some of the major American indices were down, because if this debt can theoretically keep going higher and higher, they're going to have to liquidate more and more of their positions.
Which is good for the everyday person.
In order to clear it.
To buy.
Well, I mean, from a micro level, sure, it's really good.
Yeah,
but
on a micro level.
But from a macro level, this could change trust in markets.
A lot of money going out. Yeah.
Yeah. So this could, in theory, if it gets big enough, lead to a recession, in that if these companies have to liquidate big enough positions in major market indices and major companies, then you could see that in a reflection of like major stock market indices.
That's true too, because let's say, for example, you have they had to liquidate a bunch of their Apple stock or whatever.
Yeah.
Like that could affect Apple.
Exactly.